Good morning, everybody, and welcome to this morning's webinar. On to just a word about myself. My name's Chris Dunn, partner here at Brodie's in the banking and finance department, and I specialise in social housing finance. So we'll just wait a second or two as the numbers hopefully. In essence, the key ingredients for creating a sustainability linked loan, what do we need to all mix together? Well, I picked out 5 things. First of all, the social housing provider in question, they have to develop and they have to express a sustainability strategy. So you need that first of all, you need a strategy. Then you need to decide how you're going to report to stakeholders the implementation of your strategy, how you're going to measure it and report it. And then when you're discussing this with your lender or investor, say under a loan facility or a private placement facility, then you need to think about identifying specific targets and how you're going to address compliance and monitoring. Next, there's normally a pricing mechanism built in to reward compliance or failure to comply. You need to look at how we address that. And lastly, and importantly, you need to agree a suitable review mechanism, because what we do know is nothing's going to stay still. So if we could have the next slide, please. So the first area, as I said, was just creating a sustainability strategy. It sounds challenging, this, but I would suggest for the vast majority of social housing providers, sustainability is going to be fundamental, basically, to everything you already do. By your very nature, environmental, social, and governance, or what we call ESG considerations, they're likely to be at the essence of your mission and values, and consequently your business planning decisions. And I think, just in summary, it's essentially about making a positive difference to the communities in which you're operating by building a sustainable future. That strikes me as that's what a sustainability strategy boils down to, in essence. What can be trickier though is putting it down on paper. My tip on this would be, a good starting point, I think, is to consider the 17 United Nations Sustainable Development Goals, and also the Scottish Government's National Performance Framework. And you can really build, I think, your ESG strategy from there. But whatever you do, it's essential that what you produce is going to be bespoke to yourselves, because you're not going to find any 2 sustainability strategies are the same, and they shouldn't be the same, because all social housing providers will be different. Breaking down your goals between the different headings of environmental, social, and governance can help to make the overall process more manageable. So, and this is just examples. So under the environmental heading, your overall objective might be to make a positive impact to achieving net zero by 2040. That could then drill down to some specific aims, such as reaching minimum average EPC ratings across your stock by key target dates, mitigating fuel poverty by investing in green energy solutions, and supporting green skills. However, there's no one fit solution. And as I've said before, what may work for one social housing provider won't be right for another. The social heading, well, it really should sit at the heart of what you do. After all, you're social housing providers, so this should come as the norm, and you should be well ahead of the curve. The overall objective might, in this instance, it might be linked to supporting your residents to have a healthy and fulfilling lives, and undertaking. The underlying aims, they could include things like a focus on placemaking, improving resident voice, governance. I found that's tended to be the poor cousin in terms of focus. Often it's the environmental side of things that's focused on, and that's sometimes the easier side of things to do. It's easy to say, oh, we're going to improve our EPC ratings up to an average of B, and it's straightforward and manageable. When you talk about governance, it's maybe a little bit more tricky. But it's an increasing area of focus for lenders and investors. So the overall objective in that context, it might be focused on being a responsible organisation that recognises the positive role it can make in the life of its employees as well as its customers. And then you could have more specific aims covering experience and demographics of the board, supporting the physical and mental health of your employees, and reporting gender and ethnicity pay gaps. These are just examples, but I think splitting it between these different headings, ESG, and then having an overall objective, and then sort of drilling down to some specific aims, helps to make it all more manageable in my view. And then that helps to also feed into what you might then agree with a lender or an investor. But whatever you do, it has to be bespoke to you, and there's no right answer here, or wrong answer. You just need to do what's right in terms of your own strategy. And a couple of sort of comments in relation to this. What I have found is that if you are developing your sustainability strategy, it's essential, really essential, that there's full board and executive support, and also an understanding of why it's so important. For the avoidance of doubt, and I'm sure this won't be the case, nobody should be doing this because you're just going to get a minor margin chip on the pricing of your funding. You need to be doing it because it's the right thing to be doing for the communities in which you operate and your own employees. I found a sustainability subcommittee can be helpful. So you've got a specific subcommittee appointed, and definitely having somebody appointed or identified from your own ranks with specific responsibility is really crucial. You need somebody who's really going to take ownership of it and push it forward. The only other comment actually just in relation to this is it's also important that you put enough sufficient resource into it, not just to set up the sustainability strategy at the beginning, but also in terms of regular reviews and refreshment of the strategy. It needs to have that full commitment. So if we go on to the next slide, please. So the next thing, so you have your sustainability strategy, and it's all written down, and you've got some nice pictures to go with it. So the next thing is how do you report implementation of the strategy? So here, what lenders and investors like is they like consistency in terms of how things are reported, because it makes their lives easier, because then they can compare one borrower or company in which they've invested to another more readily. But until relatively recently, in relation to ESG, there was no consistent basis of reporting. However, that all changed back in November 2020, when what was called the Sustainability Reporting Standard for Social Housing was launched. So that's commonly now another acronym, I'm afraid, but called the SRS. So it's since been revamped, as I'm sure a lot of people are aware, to include changes to align the reporting criteria with the regulatory framework for Scottish housing associations. But I think what's key to note here is the SRS has now been adopted by over 120 organisations. So if you look up their website, you'll see that the adopters of it are a lot of the larger housing associations operating in England and covering a very high percentage now of the overall social housing stock in England. There's also 35 financial institutions now adopters. So, you're talking about the main participants in the market. This is what they've adopted as the preferred reporting strategy. And for anybody who doesn't know, Link Group Limited were the first Scottish RSL to adopt the SRS. So it's definitely achieved a tremendous amount of traction since it was originally launched. So what they did was they created a reporting framework, and then that split into 12 themes and subsplit into 48 criteria. I'm not going to suggest it's the most straightforward framework. It is it's quite cumbersome, but once you look at it in the context of your sustainability strategy, I think it would or should start to make a lot of sense. So some examples of themes under environmental include things like climate change, resource management, ecology. Under social, under the social heading, they cover affordability and security, resident voice, and placemaking. And under governance, you're looking at supply chain, staff well-being, and structure and governance. So you can see it probably links back to a lot of the stuff I was talking about earlier when you're talking about putting down some sort of sustainability strategy. And the principle behind it is that it creates a reporting framework that's transparent, consistent, and comparable, and they're really important for investors and funders. And I think you'll find they're going to be important for other stakeholders as well. I think regulators, government, etc., financial reporting. I think it seems to me that this is likely to become the way that preferred reporting takes place. Now it is voluntary. And it's open to social housing providers to report however they see fit. However, if you look at the number of people who've adopted it, it does suggest this is going to become the norm. And my recommendation would be it might be prudent to adopt the strategy sort of now initially, rather than having to flip over to it at a future date if you've got a different reporting strategy in operation, because I think that can make things more complicated. So if we could have the next slide, please, again. So what you've got now is you've got your sustainability strategy. You've decided how you're going to report on it, and then you decide that you're going to take some new funding, new investment, and term sheet comes through, and the provider, the finance says, oh, and we can provide sustainability linked terms. That's really pretty much the norm now. Very unusual now to see a term sheet that doesn't have some reference to sustainability and ESG linked terms within it. So you've got to consider how do you actually then put this together. So you need ESG targets. They need to be identified by yourselves because they are your targets, and they need to link back and be consistent with your overall strategy. once you've identified what your targets, and I'll come back to those in a minute, you'll then need to identify some known performance indicators, some KPIs that you would agree against some ideally against baseline information. So for an example, your baseline might be that you've got an average EPC rating of C and you want to increase it to B over a certain period of time. So your KPIs and targets, they need to be realistic, but also challenging. And the lender investor, they'll need to be comfortable with the targets identified and the KPIs proposed, so that there's no sort of suggestion here of greenwashing, that you're going to have automatic compliance. And that's quite a big issue for lenders, investors. Increasingly, they're getting reviewed by their own regulators to ensure that they're not branding finance as sustainable when effectively or what they're including is terms that are going to be automatically complied with. It's likely that the lender investor you're dealing with will have its own in-house sustainability team, which will be very helpful and will help to evaluate and agree suggested targets and appropriate KPIs. So, there would be the assistance along the line. And what I found in practice is generally there's been, say, 3, 4, maybe 5 maximum targets, KPIs set. And what a lender will look for is they'll look for a mixture across environmental, social, and governance. They won't just want to have everything under the environmental heading. They'll want to see some that cover governance and social. So you'll have to have these targets, and I say there'll need to be KPIs agreed. And then you want to set the KPIs for a minimum number of years. So commonly, I've found that probably the maximum period that they're set for is about 5 years, 4 or 5 years. It's difficult to go beyond that without a review as to what an appropriate KPI should be. But after the initial period, there'll be provision for them to be reviewed and then reset, or potentially for new targets to be identified and agreed. So you end up with 3 or 4 targets and then some annual KPIs that need to be achieved. In terms of monitoring performance, that's generally by a separate ESG compliance certificate. Normally issued at the same time as you'd be issuing your financial covenant compliance certificate. So you do a separate one, signed by an appropriate officer of the housing provider with responsibility for sustainability. So it's self-certification, but with the lender investor having the ability to have an independent review by an appropriate third party if they have a question mark over whether compliance has been achieved. So if we could flick to the next slide, please. So you've got these targets built in. You've agreed your KPIs, and then you need to look for what you do with regard to pricing. And it is at the moment, it's common for there to be a small margin reduction applicable based upon how many ESG targets are met in any year. So the margin ratchet, it will be a few basis points. It might be like 3, 4, 5 basis points. It's round about there. I've not found there's not significant pricing reductions based upon meeting ESG targets, and you shouldn't be doing this because you're going to achieve a pricing benefit. you should be doing it because it's the right thing to be doing. But lenders still normally provide for some sort of incentive by way of a small pricing adjustment. Now that pricing adjustment, it tends to operate annually, and then it covers the immediately following financial year. So what you might get is you get a position where you issue your compliance certificate, and that might have to come out within the period for issuing financial covenant compliance certificate. So you're reporting everything at the one go on a consistent basis. And then from issue of that certificate, from a short period thereafter, 5-10 business days or whatever, then the margin would be calculated for the next year based upon what you've complied with in the previous year or the year up to covered by the compliance certificate, which would have covered the previous financial year. So, and it might be that you get 1 basis point for complying with one target, 2 for complying with another target, etc., up to maximum total of a few basis points. But it'll be something of that nature. So one specific thing you probably need to just give a wee bit of thought to is, as the ratchet's dependent upon a borrower compliance certificate, and it's likely from a timing perspective that the ratchet would take effect ahead of an independent review of compliance. Because what you would have is you'd have a compliance certificate issued, and it will say 5 days thereafter we're going to have a margin adjustment. But what the lender may be able to do is then say, and they'll need to be able to do this really, is say, well, but we need to refer this to an independent third party to verify the information. So you have this inconsistency in terms of timing. So you'd have a margin adjustment applying, but potentially thereafter, you might have a position where an independent review would find that you shouldn't have really received that margin adjustment because you haven't actually achieved compliance. So one of the issues that arises, what should you do with that sum of money you've had the benefit of by paying a lower margin than would have been the case? Now the options here are really you could repay it to the lender, but I found in practice lenders don't like that as an option. That can create internal issues in terms of money having to go back to the lender investor. You could provide that, well, a sum equal to that will need to be used for a specific ESG approved purpose or for some charitable purpose linked to ESG, which sounds like not an unreasonable approach. The only thing I would say in relation to that is everything you do is based upon sustainability in terms of your strategy. And ESG is really at the heart of what social housing providers do. So it just seems to me a little bit odd that then you would be paying a sum to some third party or having to prove that you were using it for some sustainable purpose. So I have to say what I found happens in practice is the point's ignored. There's not a repayment. It would just be that you get the benefit of that, but then at the end of the next year, it would be adjusted again. That seems to be the approach that I've found has been taken in practice, and potentially just linked to the small amount of what the incentive might be. We're only talking about a few basis points here in reality. Point to note, we are now occasionally seeing a two-way margin ratchet operating. So this would be providing for an increase in margin triggered by any ESG linked targets not being met. And I think that's the way the market will go. Previously, we've had reductions, but I think there's increasingly an expectation of compliance with ESG, relevant ESG standards. If you're not hitting them, you might find that the money's going to become slightly more expensive. So you'd have a margin increase rather than a margin reduction. So if we could have the next slide, please. So following up from that, it is important, it's really important to build in a suitable review mechanism. Whatever targets are set and KPIs, it's likely they won't remain alive for their full period. So particularly if you've got long dated facilities being provided, they're not going to remain constant. So there tends to be a trigger for review periodically, say every 5 years or something of that nature, or a trigger if a particular ESG target is just no longer applicable or relevant in the market, which could happen. And in such circumstances, there's provision normally for a borrower and a lender to be given a period of time, a few months, to agree on alternative targets or KPIs, and that they would then apply in substitution for the existing targets and KPIs. Ultimately, if no agreement's reached, then the loan facilities would cease to be treated as sustainable, and the parties to them would not be allowed then to brand them as sustainability linked. So if you'd marketed, you'd had a sustainability loan in your accounts or in reporting, you wouldn't be able to continue to do that clearly if there were no longer any appropriate targets agreed with the funder. So that sounds a lot, that, but actually the sustainability wording that we tend to drop into facility agreements tends to be quite brief. So I think there's a real risk here. You can drill down into too much detail in relation to this as a topic, and I think that risks are becoming unmanageable. And I've found that funders and investors prefer a less detailed approach. So it tends to be fairly brief. We tend to add in a couple further schedules into a facility agreement. One would be the sustainability linked terms, and the other probably the form of sustainability compliance certificate. When we're dealing with a syndicated loan transaction, it's common for there to be a sustainability coordinator appointed. So rather than having to deal with each lender separately in relation to sustainability, they all appoint one to act as sustainability coordinator to agree the terms, and that's usually very helpful. And it will be a lender with suitable support team that specialises in this. So the last comment I was going to make was that at the moment, sustainability linked terms are optional, but we do see them in every term sheet, and increasingly, I think they're just going to become the norm. And I don't think we're far away from them becoming mandatory and an expectation to be found in facility agreements and similar investment agreements. So to the extent anybody's not on board with having a sustainability strategy, then I think it's something that really needs to be put quite high up the agenda as something to do, because I think you're going to find that in the near future, this is going to become pretty much a standard type provision that you'll find in a facility agreement, in the same way as you find all the other provisions that everybody's used to. So that's all I was going to say in relation to that. Was just wondering if there were any questions. So I can see one, and in a nutshell, what somebody's asking is, it's a valid point. Given we've now got cost of so many other issues affecting the sector in terms of cost of living, rent freeze, etc. Is this something that's going to continue to receive the focus it has to date? And I can see in the short term that may be a view that could be taken. There might be some sort of less prioritization of this as an issue, but I don't think that would be the right thing to do. I think in the medium term, this is going to continue to be and to increase as a very important area of focus for the sector. I think where the social housing providers should be very confident is that they already really do this. It goes to the nature of what they are. So you're already well ahead of the curve. But if you look currently at the demand from the wholesale markets for investments into sustainable in investments or finance, then the demand is huge. So I think that trend is bound to continue. So I don't think you can do anything else but then really, grasp that this is going to be something that needs to be addressed. As I said at the outset of the webinar, you need to be doing it because it's the right thing to do. You shouldn't be doing it just because you've got funders looking for you to do it, but the reality is they will be looking for you to do it. So I think I think it's something that just needs to really be taken into account and given as much focus as possible, subject to all the other pressures that everybody's facing at the moment. But thank you very much, everybody, for attending today, and I hope you found that useful. Thank you.